Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand strategies, insights, and tips to help you master the game of building wealth. Okay, today I'd like to talk about fixed interest rates. Mortgage interest rates, of course, when to fix, when not to fix. It's a question we're commonly asked, particularly when interest rates move up or down, and they've certainly been pretty volatile over the last couple of years. But it's a fair question in terms of when to fix interest rates. And, many borrowers are tempted to fix when fixed rates are less than or lower than variable interest rates. But like with all financial decisions, the best answer is not on gut feeling. Let's base it on evidence. And so today I'll really want to unpack what a normal interest rate settings look like. How do we think about the RBA neutral rate? And I'll get into why that's important. It helps us, make long-term financial decisions. And then I'm going to delve into a couple of decades of data around fixed interest rates. And I've got some, what I think are really interesting insights to share with you. So I think it's good. Let's look at interest rates in terms of, where have they been? And that gives us a chance to sort of benchmark it or set some future expectations, if you like. And the problem, though, is average interest rates aren't particularly reliable because things have changed quite a lot over the last few decades. If you think in the early 90s, anyone that sort of lived through the early 90s recession will tell you, mortgage interest rates got to 16, 17%. And that experience has certainly, sat with them for a long time. But lending standards, indebtedness, all these sorts of things have changed dramatically. So looking at average interest rates over, say, 30, 40, 50-year periods doesn't necessarily give us a good reference point. Also, the mortgage market is a lot more competitive today too. So looking at standard variable interest rates, even say 10 years ago, isn't that comparable because interest rate discounts are a lot larger today. So the effective interest rate is therefore lower. So I think the good benchmark to go off is the RBA cash rate. And so what I suggest is let's think about what the RBA cash rate could be longer term, add a margin on top of that, today's margin, and then that gives you a sense of, what you should plan for in terms of interest rate expectations, particularly when you're making a long-term financial decision such as buying a home or an investment property or any of those sorts of things. So the first thing we want to really think about is what's happened to interest rates over the last period of time. So, the thing to consider then is household indebtedness. And I'm going to share a chart with you if you're watching this video, listening to this or watching this on YouTube. I'm going to share the chart. If you're listening to it on a podcast, of course, the chart will be on the blog on the website. And like always, the link is in the show notes. And what it does is chart household indebtedness and the RBA cash rate. And so what you can see on this chart is that since 2003, so almost the last sort of 20 years, household indebtedness has doubled from an index perspective. And whereas interest rates have kind of been all over the place since then. So, if we look back over time, for example, just before the GFC, the cash rate got to 7.25%. And in the mid-90s, the cash rate was 7.5%. Whereas in contrast, the recent peak, at the beginning of this year, 4.35%. So I think what it shows us is because household indebtedness has increased, households are far more sensitive to interest rate settings today. And as a result, the RBA doesn't necessarily need to increase interest rates to the same level that they had to, before the GFC and in the 90s in order to sort of cool the economy. And in fact, if you look at the time-weighted average cash rate over the last 10 years, it's only 2.1%. And over the last 20 years, about 3.4%, which is kind of very close to, where it's sitting at the moment. Now, of course, the COVID years kind of distort those numbers. So if you exclude the COVID years and look at the decade before COVID, 2.6%, still very low. And the 2 decades before COVID, about 4%. So you can see that certainly there's a longer term trend of interest rates being on average lower than what they were, say, in the 2000s and certainly in the 1990s. And I think this helps us make long-term financial decisions to kind of understand, what interest rate do we have to kind of make friends with. The next thing we want to think about is what the neutral rate setting is for the RBA. So this is important because this sort of informs us about what kind of the average interest rate is. And then once I've determined what the neutral interest rate is, I then sort of test my cash flow and ask myself, well, what happens if interest rates are 1% above the neutral level? What happens if they're 2% above the neutral level? And just to understand your cash flow sensitivity to potential interest rate changes. And that's how I'd go about sort of planning and working out, is borrowing a certain amount affordable and prudent in my situation. So the neutral cash rate is really just a useful guide because it's neither restrictionary or it's neither contractionary or expansionary. So that is from an economy perspective. It's really kind of is doing neither. Now the RBA estimates its neutral cash rate is around 2.75%, but a lot of economists believe that it's 3.5%. The truth is it's hard to precisely measure in real time, and the neutral rate can shift over time due to sort of structural factors in the economy as they change and so forth. But I think it's reasonable to expect the neutral rate is somewhere between 3 and 3.5%. Now, what we need to then do is add the margin on top of that because, of course, we can't borrow at the RBA's cash rate. The banks need to make some money. So at present, principal interest home loans are typically priced between 2 and 2.5% above the cash rate, and interest-only investment loans are priced around 2.5 to 3% above that cash rate. So therefore, the long-term interest rate that I should make friends with is somewhere between 5 to 6% for home loans on a principal interest basis, or 5.5 to 6.5% for investment loans. And you probably make sense to choose the midpoint of those ranges. And then, as I said, sort of test the sensitivity around your cash flow by adding sort of 1 to 2% to see how it impacts and if it's still affordable. So I guess what we're sort of saying is that whilst we all talk about and hope for interest rate reductions, the current settings aren't too far off what we should consider normal. They're within the range. And therefore, if we are experiencing, challenges, cash flow challenges at the moment, then it could be a sign that you've borrowed too much or you're spending too much on living expenses or it's just not right. And so there's a structural thing that needs to be changed there in terms of debt exposure. Really, your borrowing situation should be relatively comfortable at the moment. Of course, the challenge is that you've come off really significant lows in terms of interest rates. You think a couple of years ago, we were borrowing at sort of 2%. So of course, it's a bit of a shock. We should make friends with the fact that, it's not too far off what is considered to be normal. So fixed rate borrowers, let's talk about fixed rate borrowers and let's look at the evidence because as should know by now, I'm very focused on making evidence-based financial decisions. And I think it just helps us avoid making costly, potentially predictable mistakes. Because after all, if all the evidence points to, fixing is not the right thing to do, then you'd be silly to kind of ignore that data. Now, the RBA's tracked 3-year fixed rates since 1990, so that's where this analysis begins. What I've done is worked out whether fixed rate borrowers have been better or worse off over that particular time. And so between 1990 and 2025, 65% of fixed rate borrowers were worse off. If we excluded the COVID period, because banks at that time were lending to, the RBA was lending to banks during that time at only 0.1% fixed for 3 years. So essentially giving them free money for 3 years. And what you would all remember that interest rates, fixed interest rates were very low at that particular time, 2-ish. They even got below 2%. So that's a very unusual period of time. So if we exclude that and just look at, say, 1990 to 2020, which is obviously a 30-year period, 71% of fixed rate borrowers were worse off. So, the data is pretty compelling that, fixing your interest rate is not necessarily a particularly great idea. Now, if we go back to the 1990s, as I said, interest rate settings were different, household indebtedness was different, the market was different, access to information was different, all those sorts of things. So I think it makes sense to focus on, say, the 20-year period prior to COVID. So let's exclude the last 5 5 years because interest rates they started that period below average. They went to zero pretty much, the cash rate, and then we've had a substantial uptick. So it's been a pretty volatile period. I think we should ignore the last 5 years. And so if we focus on the 2 decades, say 2000 to 2020, that's, I think, a good period to look at. And so here's what I found. 63% of borrowers were worse off, and of course, therefore, it means 37% of borrowers were better off. Now, you look at that, you've got a greater than, there's more chance that you're not going to be better off by fixing, but it's not as compelling as, say, between 1990 and 2020, that 30-year period, where it was 71%. However, the up and downside is the key thing to understand here. So when fixing worked, and when you were better off, the average saving was 0.36%. So about a third of 1%. Whereas when fixing was worse off, the average cost was about 0.7%. So when fixing didn't work, which again was 63% of the time, you were 0.7 worse off. 23% of the time, okay, you were better off, but only by a third of a percent. So if you look on a risk-adjusted weighting approach, or basis, I should say, it translates to a cost of fixing of about 0.23% to fix your interest rate. And so I've got all that data again on the blog on the website if you want to sort of delve into it. But, it's pretty compelling data. Now, of course, thinking about whether you're going to be better or worse off is only one of many factors that you need to consider when contemplating a fixed interest rate. And there are other sort of structural flexibility, non-financial considerations that you also need to be aware of and also weigh up. So the first one is break costs, and break costs are unascertainable at the time when you enter into a fixed rate. So, if a client asks us, what are the break costs going to be? We say, well, who knows? Because it really depends on how interest rates move after you fix your rate. But the issue is that if you want to break a fixed rate before you finish the term, either because the fixed rate is too high and you want to switch back to variable, or you want to refinance to a different lender, or you want to sell the property, or you want to change your loan structure, something like that. If you want to break a fixed rate, you could be up for substantial fixed rate costs. And I've seen some of these fees, $50,000, $70,000, that they can be substantial. Essentially what the bank will do, and it's a bit of a black box calculation, which I think the government needs to regulate, improve the regulation around, because we've been through periods of times where really pre-GFC, when interest rates started to really escalate and some clients wanted to break fixed rate costs, you would compare two different break fees. CBA would charge for very similar loans $20,000, and another bank, say ANZ, might charge $5,000. Doesn't matter about the banks. I'm not picking on CBA, but I'm saying that wasn't a lot of consistency. But essentially what the bank says is that they will charge you whatever they lose out by you breaking the fixed rate. So what they'll do is, if you've got on a 5-year fixed rate term, and let's say there's 3 years remaining, what the bank will do is work out how much can we re-lend that money for 3 years, and then they'll charge the difference for a 3-year period. So you're actually better off by breaking the fixed rate. If you're stuck in a fixed rate that's too high, you're actually trapped, because the break fees, will probably make it, they'll be too cost prohibitive to break that. But the point is that you just don't know what those costs are, and those you could end up paying a lot of expense, particularly if you need to change a fixed rate because of something completely unforeseen. That's the issue, right? That we all make these decisions, financial decisions, and we think, oh no, it'll be fine, I don't expect any changes. But the problem is, from my experience working with clients for many decades, is many changes or changes that happen in our life, a lot of them are unexpected. So we just need to keep that flexibility. The second consideration is that most lenders don't allow you to attach an offset account, a true offset account, linked to a fixed rate loan. There are some notable exceptions in Australia: Adelaide Bank, Bank Australia, and Bendigo Bank. And there might be some others as well. Heritage Bank, I think, maybe. Look, there could be others as well, but there's only a handful of lenders that allow you to attach an offset account. Now, an offset account can be really valuable, particularly homeowners, parking surplus cash in there to reduce the amount of interest that you're paying, of course. And for investors, they can do the same thing while preserving the original tax deductible nature of the debt. So one way to kind of navigate this potential downside is is obviously to split your rate and, fix some of the loan and then have some loan variable and attach an offset account to the variable portion. But we just need to think about, if you're contemplating a fixed rate, you need to think about whether your lender allows you to have an offset and whether that's going to be important to you. The next consideration is limited extra repayments. So most fixed rate loans cap the amount of repayments you can make. Probably not a big deal for investment loans, but could be a bigger consideration for home loans, particularly if your goal is to, make accelerated repayments. So the cap, it typically is around $10,000 to $30,000 over the fixed rate. But you've got to look at the finer detail. Every lender has different rules around that. But again, if you've got a home loan and you want to repay it as fast as possible, fixing your interest rate might not allow you to sort of do that. And lastly, it can reduce your flexibility in terms of the potential to refinance in the future. So it can lock you into a particular lender. That lender, the valuation of the property from that lender might be poor, whereas another lender is going to value the property a lot higher, and you might be trapped because of that fixed rate, and then breaking the fixed rate could end up being really costly. So it means that you're tied to that particular lender, that particular lender's credit policies, and that particular lender's valuations for the period, for the duration that it's fixed for. So personally, and also professionally on behalf of my clients, I value maintaining flexibility. As I said, there's lots of things that can change in our life, and many of them can be unexpected or not predictable, from this point in time. So I like to make sure that we can always, restructure loans, refinance, shop some valuations around, keep that flexibility if we want to. And, fixing interest rates don't necessarily make that easy. Personally, I certainly fixed a couple of loans during that COVID period. I mean, most Australians did. The amount of fixing that was going on was all-time highs. And that was a no-brainer, right? You fix at 2%, that's the bank's margin, like how much they make on the home loan. It's never going to, even if the cash rate went negative, or maybe negative, the interest rate could come down. But when the cash rate was pretty much zero, you knew that the downside, interest rates were almost certainly weren't going to fall further. So it was a no-brainer. But that is the only time over the last 25 years I've fixed a loan. So I typically prefer variable, and all the data, the overwhelming data shows that it doesn't make a lot of sense. What I wanted to do now is ask myself, let's look at the times where fixing made sense. So what can we learn from that? Like, will there be a time when fixing makes sense, and what indications will there be that we're at that sort of particular time? So that way I can say, don't fix unless this happens, for instance. So there were two sort of standouts over the last sort of 35 years of times where fixing made sense. Now, of course, the one we just spoke about from late 2020 to early 22, there were some ridiculously low fixed rates. I think the lowest was like 1.8%, sort of around about that period, that sort of mark for 3 years. I don't think we'll ever see those interest rates again. And when you look at where borrowers better off, borrowers over that time ended up being somewhere between 2 to 3.5% better off compared to variable rate borrowers. A really unique period of time. Of course, when those fixed rates were offered, it was really pushed out by the central bank in terms of lending money almost for zero for 3 years to the banks. And then the interest rate shock, of course, the RBA was saying back in 22, we're not going to raise rates until 24. And we know that wasn't the case. So a really unique time. The other period of time was between early 2005 and mid 2006. Now, I appreciate there's going to be probably a reasonable cohort of people either watching this video or listening to this podcast that will go, I don't even remember the time back then. Well, lucky I'm old enough to remember on your behalf. So fixed rates at that time for around 3 years were being offered at 7%. Now, you would probably think today 7% fixed for 3 years just doesn't look attractive. And in hindsight, compared to today, it doesn't look attractive. But what happened is the RBA hiked the cash rate from sort of high sixes to almost, high eights, almost 9%. And borrowers end up being better off in that time. And that was just before the GFC. So that sort of caused the GFC, of course, high interest rates, but that was kind of a pretty unique time. I think in both those scenarios, I don't think borrowers could have reasonably predicted that they would be better off by fixing their interest rates, except for maybe 21. Those interest rates between late 2020 and early 2022, they were a bit of a no-brainer, right? That was really obvious, but the GFC one, I'm not sure that was particularly obvious at that time. So therefore, my conclusion really is that there's only sort of two reasons to fix your interest rate. When the deal is so clearly in your favour, so you've got to have another kind of COVID event. I mean, I don't want another COVID event, by the way, particularly as someone that lives in Melbourne. We've all been scarred by that, so we don't want that. But in that situation, of course, it makes sense. And the second situation would be, if I needed the protection. So if increasing interest rates would place unacceptable pressure on my cash flow, then I should fix. And really fixing, even if I'm going to pay a premium, it's like paying insurance. So for some people, fixing makes sense as a protection mechanism, but the wrong reason to fix is because you think you will be better off, right? So don't sit there and compare fixed rates today and variable rates today, because history tells us overwhelmingly that you won't be better off. Now, as I'm producing this podcast, fixed rates are marginally lower than variable rates at the moment. So 3-year home loan fixed rates around sort of 5.5%. Investment interest only fixed rates, 3 years again, 5.3, 5.8%. I focus on 3 years rates because that's the data that the RBA has collected since 1990. But of course, you can typically fix for 1, 2, 3, 4, or 5 years. Banks used to allow you to fix for 10 to 15 years, but they were wildly unpopular products. It'd be a big move to fix for that length of period, particularly around the restrictions that Australian fixed rate products have. Whereas, say, in the US, for example, you can fix for 30 years, but those products are more flexible, so they're not that comparable to what we've got in Australia. So 5 years fixed rate, I would look at a 5-year fixed rate, but I'd be really careful. I'd have to be absolutely sure it was an absolute no-brainer like COVID. And so I think 3 years is kind of, it's long enough to give you some interest rate protection and short enough not to necessarily forego at least too much flexibility. And so that's why I've sort of focused on the 3-year term in today's podcast. The other thing you need to be really aware of, and this gets proved time and time again, is that interest rate expectations can change on a dime. So that is that interest rate expectations can literally change overnight. And we've seen that recently with, inflation data, and we get an inflation reading every month, and we get then related news stories every month of, okay, the RBA is going to cut rates. No, then next month they're going to hold rates. The next month, they're going to increase rates, and we ride this kind of roller coaster ride. But the thing is to realize is that when you're making that comparison between fixed rates and variable rates, don't be swayed by all this short-term noise around interest rate expectations and people guessing what interest rates are going to do, because it can literally change overnight. So you're better off to ignore that. The other thing to think about is that if you're going to fix interest rates, what you're doing is taking an opposite view of the money markets. Now, fixed interest rates are set by international and Australian money markets. So that's just a whole bunch of institutions, very smart institutions that study the market, that trade on a regular basis, taking positions around where they think interest rates are heading. And they're selling fixed rate bonds, buying fixed rate bonds, and that's what impacts the cost of fixed rate products. So therefore, by saying, yes, I'm going to take a low fixed rate, or a fixed rate that's lower than current variable rates, you're actually taking the opposite view of the market. And that doesn't make sense. So it doesn't make logical sense. And in fact, that's why the data suggests that, you're on a risk-adjusted basis, you're going to be worse off. So I should mention, lastly, before I wrap up today and get into some Q&A, that some mortgage brokers, and there are an absolute minority, a tiny minority of the market, I hope, might suggest you fix your interest rate because it locks you in. So they get a trail commission, of course, mortgage brokers do, and they might say, oh, well, if you fix your interest rate for 3 years, to their mind, you're not refinancing for at least 3 years, and that locks in their trail commission. Now, as I said, most great brokers won't take that approach, of course, but it's sort of worth mentioning. Okay, for the people listening or watching on YouTube, I'm going to leave it there now. And for the people listening to the podcast, I'm going to get into some Q&A. Okay, let's get into some questions. First one is from Sam. Really good question in terms of working with parents. Put my financial planner hat on. Helping parents with their financial sort of situation. Okay, so Sam writes, my question is regarding the inheritance tax. My dad is in his late 70s. He's self-funded with circa $1 million in super, all of it from concessional contributions and growth over the years. I'll mention in a second why that's an important statement. He also has Australian equities worth $800,000 that have a very low cost base, have been passed down to multiple generations. Cash in his personal name about $300,000 and an unencumbered house for $900,000. He has no personal debt outside of credit card, which is paid off each month. His income each year is about $6,000 from interest, $35,000 from dividends, and which have about $15,000 of franking credits. So he typically gets a tax refund because of the franking credits. My siblings and I are all adults and non-dependents. Whilst he remains fit and active, we want to have a conversation with him about the best way to look after his super from an estate planning perspective. I'm not sure if he's aware of the inheritance tax, and I don't want his hard work to be gobbled up by the tax man. My mum has passed, so there's no spouse whose super can be passed to on a tax-free basis. He only draws the minimum from super and essentially is living off earnings and any dividend and franking income that he gets from the share portfolio. The capital of super is not being eroded. He is, of course, also past the age where he can take a lump sum from super and recontribute as a non-concessional contribution, meaning the benefits paid to me and my siblings will be taxed from the estate. Wondering if you have any strategies I could discuss with him that could assist in minimizing any super inheritance tax. Okay, Sam, great question. And, as Sam suggested at the beginning or said at the beginning, that the balance has accumulated mostly from concessional contributions. That means most of his dad's balance is going to be taxable. And essentially it means he'll end up paying about 17% tax. And if the balance is $1 million, that's, about 170,000. Of course, look at how quick I did that maths. That's impressive, not? Anyway, so it's a considerable amount, okay? And we spoke about this, I think actually Campbell spoke about this in episode 376 back in October, where in fact, the title of that was How to Avoid the 17% Death Benefit Tax. If Sam's dad was younger, you're right, we would try and recontribute it. So you pull it out as a and then recontribute as a non-concessional contribution into a fresh account. And then by doing that, what you do is convert it from taxable to tax-free, and then there's no tax. But the non-concessional contribution age limit is 75. So we've missed the boat because Sam's dad is in his late 70s. If we look at his estate, for instance, he's got the family home. Well, that's easy. You inherit the cost base for that asset. So if it's sold by the estate within 2 years, there's not going to be any tax payable. If the estate holds it longer than 2 years, which can be a bit challenging to do, he might have to pay a little bit of capital gains tax, not a big deal. If the home is passed on to beneficiaries of the will, then they will inherit the cost base, which means the cost base will become the market value at date of death. So we don't really need to worry about the home. Like that's pretty tax effective. The cash, there's not going to be a capital gains tax with that. The shares, because they have a really low cost base, to those that don't understand what that means, it means that there's a lot of unrealized capital gains. We want to then put those shares into a environment that's going to be really tax effective. So therefore, Sam, in your dad's will, I would strongly advise you to have a testamentary trust. And what you can do is have those shares go into that testamentary trust. And the benefit is then, or testamentary trusts, you could split it across 2 or 3, depending on how many beneficiaries there are. And the benefit of that is that you can then distribute any capital gains to tax-effective individuals. And if it's a testamentary trust, of course, individuals under 18 can still benefit from the adult tax rates. So it's very tax-effective to deal with all these unrealized gains, because if they're in stocks like BHP, CSL, CBA, they're the usual names that you see in those portfolios, you might want to strategically take profits and reinvest. So for example, if I had CSL and CBA, maybe not CSL at the moment, I'd hang in there, but CBA I'd be taking some profit, for instance. And so sometimes capital gains tax consequences dissuade people from taking profit or changing the portfolio, but at least those portfolio changes are, far more palatable when you're able to manage the tax. Now let's talk about the super, because there's nothing you can really do with super. What will happen with super is that the only entity that Sam's dad can nominate, he needs to prepare a death benefit nomination, hopefully a binding death benefit nomination, and even better, a non-lapsing binding death benefit nomination means that it doesn't lapse, and that the trustee's bound to pay the super where the nomination suggests or dictates. He'll have to put his legal personal representative as his death benefit nomination, which means that the super death benefit payment will go into the estate. And because that super death benefit payment isn't ending up to a financial dependent or interdependent person, it'll be taxed, right? So you can't avoid that. What you could do is take the money out of super. Now, I'd be cautious about this because, of course, super is tax-free, so there's nil tax payable. But what could happen, for instance, whether it's the entire balance or some of the balance, dad could take that out of super and maybe put it in a family trust, for instance. And if there were enough beneficiaries, tax effective beneficiaries of the family trust, maybe you could still avoid paying any capital gains tax or income tax. Remember, capital gains tax would still be accumulating, so there'd still be unrealized capital gains there, where that wouldn't be the case if the money was left inside super. So that's why I'm saying you want to be careful about this. But for instance, if dad had a lot of grandchildren or even potentially great grandchildren, just individuals that are adults that don't have much or maybe nil taxable income that he could distribute to that are tax effective, then maybe taking it out of super, putting it into a family trust could work. And of course, the family trust is going to continue on beyond his life. So it's not part of the will, but he would hand over control over that trust in his will. So, replacing him as the appointer of that trust, and the appointer then has control of that trust. The alternate strategy is to take the money out of super before dad dies. So, of course, sometimes it's unpredictable, so it's not a very easy or consistent strategy to be able to implement. But, if dad became really unwell and his life expectancy was relatively, limited, you would then take the money out of super at that time. Because if he takes the money out even the day before he dies, of course, that's completely tax-free to him, and then it will go into the estate. There'll be no tax to pay. So they're the sorts of things. I'd certainly put a testament trust in the will. You might then think about, do we take money out and put it in a family trust? That'll just depend on the family's decision, of course, and the beneficiary's decision and the dynamics and the tax planning and those sorts of things. But failing that, it's really just a case of, trying to forecast life expectancy and then taking the money out before the individual passes away. Anyway, Sam, it's a really good question because this is going to become more common. It's something we get asked all the time from clients with elderly parents. And of course, we want to, try and preserve their financial legacy as much as possible, and better to sort of pass it on to family members than obviously the ATO. But great question, and thanks, Sam, for writing in. Okay, I squeeze in one more question from Lauren. Lauren writes, I've just inherited $3 million from my late father's estate. I've got $500,000 at the moment. Expect to have access to the rest of the $5 million at the end of probate. I'm 40, single, no dependents, and no future plans for that. I own a home in rural Victoria that I've paid off. It has a 4-bedroom rental, so a rental property, and a separate Airbnb on site that earns $40,000 a year. It's in my discretionary trust to access some tax losses within the family trust. I also live on the same block in a self-contained unit. I have no other debts. I'd like to earn $100,000 per year, then reinvest any other income. My plan is spend $1 million on buying a property closer to Melbourne that I'd potentially live in with some housemates and renovate. I'm unsure how to invest the rest. I have a great accountant who's going to refer me to a financial advisor. I'd love to know what you think. Okay, I mean, it's a really difficult question to answer, Lauren, because, how long's a piece of string? And, you really do have to develop a strategy that is congruent with, the individuals behind the strategy and their goals and so forth. So, I can throw out some ideas. I can maybe talk about what I would do if I was in your shoes, but whether it's going to be appropriate for you is really challenging. And I guess that's true with almost all the answers to these questions in the Q&A section, but I just wanted to sort of say, well, that's a difficult thing. When choosing a financial advisor to work with, it's great to go off a referral from your accountant, and I'm not dissuading you from doing that, but again, just be just be careful. Not every financial planner that's aligned with an accountant is going to be a great financial advisor. And hopefully they exhibit some of the things I talk about in the podcast in terms of if they're going to invest in shares. Well, actually, firstly, they've got deep knowledge of both property and shares, so they can advise you on how much to put in which asset classes. And then when it comes to shares, hopefully they adopt a similar kind of rules-based, evidence-based approach that I talk about in this podcast. But it's considerable money. So it's certainly worthwhile paying for financial advice. If you've got $3 million to invest or find a home for, and you're 40, how well that you make those, the quality of your decisions over the next couple of years will have dramatic results over the next 40 or 50 years. So it's absolutely worthwhile getting some financial advice around it. Would you spend $1 million on a property closer to Melbourne? I'd want to explore why that could be, or that might be an option you're considering. So it's really a case of clarifying, is this a lifestyle decision or is this to make money? Because if it's to make money, then I'd probably say, no, let's increase the budget and buy something even better in Melbourne, not closer to Melbourne. So that is an investment grade asset. So let's not take any haircut on quality and so forth. Might even double the budget and spend $2 million and buy a really great house in Melbourne. When I say great house, I'm talking from an investment perspective, something that's really going to drive long-term capital growth and generate really good quality returns. If it was a lifestyle decision, well, then that's not something that you can provide financial advice on, unless the individual, I thought the individual was doing something they couldn't afford or would compromise their future retirement, which is not the case in Lauren's situation. So let's say we put $1 to $2 million in property, which leaves another $1 to $2 million to find a home with. Well, I might put some in super, but I probably wouldn't put a lot in super because you can't access it for another 20 years. And so I'd want to keep a bit of flexibility to be able to utilize that money. I talked to you about whether you have anyone you can distribute to. You talk about you've got a family trust, the rural property in the family trust, which typically I'm not a big fan of just from a land tax perspective. But anyway, it is what it is. I would talk to you about whether you've got anyone to distribute to, how we're going to save tax. But even if you didn't have anyone to distribute to at this stage, I'd still probably lean towards putting that money in a family trust with a corporate beneficiary. You might put it in the same family trust that you've got, and depending, especially if it's got carried forward capital or income losses, but that's just something you'd need to explore. But I probably want it in a family trust environment, and then I could always establish a corporate trustee in the future, to cap my tax rate at 30%. So you could certainly do that. And then I'd probably put it in the share market, to be honest. But I'd be careful about how I invested $1 to $2 million in the share market. Of course, I would avoid the most lofty areas or unattractive areas of the share market at the moment, which is really large cap US. But I've spoken about that in podcasts before. And in fact, Lauren, you probably, I would recommend go back and listen to episode 380 because that was in October. I'll record that. That'll sort of talk to, some of those points that I just mentioned. But I think I would invest probably some of that money, maybe a couple $100,000. I would invest some more on a monthly basis, but I would keep my powder dry. I'd keep, a reasonable proportion of the money. I would park it in, sort of subordinated debts or mortgage-backed securities, these sorts of ETFs, fixed income ETFs that are very low risk, that are going to pay you sort of 5-ish% every month. And, well, not 5% every month, but 5% annualized every month. And then wait for the market to, give you some volatility and then buy the dip and dollar cost average into the market. And if it took me, 2, 3, maybe even up to 4 years to get all that money invested, I wouldn't be that worried about it. If you look at the data, because I'm going against the data here, the data says invest the whole thing all at once. That's what's the, if you look at statistically what would have worked or not worked, but I just wouldn't necessarily do that. Okay, thanks, Lauren. Hopefully that answers your question. Thanks to everyone that writes in, and until next week. Well, in actual fact, next week I'm going to talk about listed property, so real estate investment trusts versus direct property. I've got some really interesting, actually, when I started writing that episode, I had a certain belief, and after writing that episode, I changed my belief. So it was a really interesting one. I hope you find it interesting too. Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.